Hello everyone. So Atlanta Fed is predicting that US economy is near around contraction. Um, Federal Reserve has never historically correctly predicted US GDP growth. They are always behind the curve, especially uh, when it comes to contraction or recessionary rates. Um, and I'm not I will definitely not be surprised if indeed that is the case here. Um, Historically speaking, I mean, you take 2008, 2007, 2013, 14, or 2019 when repo crisis happened. Federal Reserve has never been able to predict all such events. Um, Now, as far as these numbers go, um, I believe U.S. economy has been in recession since 2007, 2008. Um, they have only been able to fudge the data or show some sort of economic growth since then because of quantitative easing or negative interest rates or 0% interest rates. All these shenanigans. Realistically, had GDP or the economy was given a chance to come to an equilibrium in 2007 2008, it would have been a great recessions, great depression sort of situation. Probably even worse, and it would have taken easily some um, 6 to 7, possibly 10 years to recover. But apparently they didn't let it. So economy has kind of sort of become zombified. And all these datas and predictions that they come up with here, they in my opinion, they are kind of sort of meaningless. But nevertheless, let's see what Atlanta Fed is saying. The Atlanta Fed just released its latest GDP Now forecast for Q1 economic growth in the United States, and it's a doozy. This chart is from JPM showing growth momentum, and as you can see, growth momentum is now below negative 10%, but it started in the previous quarter, if you see here. All of which have sent the initial GDP Now model estimate for real GDP growth, seasonally adjusted annual rate, in the first quarter of 2022 to just 0.1% on January 28th, i.e. on the verge of contraction. So pretty sharp decline there from just 7% to 0.1%. Not exactly in contraction range, but just around that. So Atlanta Fed's estimates are unusually on the lower side, and the consensus is increase of GDP or growth, positive growth from 2 to 5% from financial institutions or data collection institutions, which had a little impact on rate hike expectations, slightly lower. So current interest rate hikes in financial year 22 to 2022 is about 5, and that has gone down to 4.72%, which is not much at all. So really, in order for rate hike expectations to be going much lower, let's say just around 0, the GDP estimates will have to also go much lower, or contraction should have to happen at least in 2 consecutive quarters, which would officially make it a recession, and that would give enough ammunition and excuse to Federal Reserve to not rate hike any further. And I think this unusually lower estimate is indicating toward that. So I think they are using these numbers to create an excuse to not rate hike anymore. How does that help Federal Reserve? So the way it helps is both ways. So Federal Reserve has two mandates. First is um, price price stability, and which means that inflation has to be within that 2%, and that's it. So not deflation, not high inflation, just that inflation of between 1 to 2%, and that is considered price stability. And as long as that's the case, that's achieved. Now if the economy is in recession, that means the current tailwinds of high inflation will be affected by the headwinds of deflation because of recession. The demand will significantly reduce, and potentially, let's say, if the disruptions around supply chain are able to then meet the lower demand, everything gets into equilibrium, then they achieve their goal. So they will be able to push down the inflation, if not all the way to 2% level, but make it disinflationary, and that would be good enough, at least from Federal Reserve perspective, to not rate hike. So that's the first criteria that they will achieve. The second one is the full employment. Currently the employment is full, so the unemployment rates are very low, so about 4.5%. But what they are not loud around is the participation rate, the labor participation rates. Participation rates are much lower. They haven't even reached the pre-pandemic levels. If I'm not mistaken, the participation rates are 1.5% less than what they used to be before the sickness, and that is a significant number. If the total number of participants are in somewhere around the 160 million, then 1.5% is a big chunk. And partially they are not participating because people are flushed with cash because of the loans and PPP loans and STIMI checks and so on and so forth, but partially because of the mandates as well. So people don't want to follow the mandates, sickness mandates, and that is affecting the participation as well. But nevertheless, if the economy goes into recession, then it means the lot more people potentially will get unemployed because the companies will contract and they might lay off staffs. Not only that, it will all the savings have almost run out in the US economy, and which means going forward more people will start coming into level 4 labor force, and if people are getting retrenched because of recession and contraction, then that also increases the unemployment rate further. So it means that the Federal Reserve is not achieving its second mandate of full employment, and that gives another excuse, or that actually supports its justification for no more rate hikes. So that's the mechanism, I think, where Fed is going with. But we have to also keep in mind, for Fed to really achieve that, they will have to justify a recession, and as I said, the justification for recession, or official declaration of recession, is 2 consecutive quarters of contraction. Now previous quarter, the the there was no contraction. In fact, as I will show you, the GDP increased by 7%. And if GDP increased by 7%, and let's say it contracts in this quarter, then Federal Reserve can do a nominal price increase of interest rate price increase of 0.25%, let's say quarter percent rate hike. But then when next Fed meeting will happen after that would be sometime May, and they will have enough data points to justify contraction or recession for the second quarter of 2022, and hence they will not rate hike any further. And President Biden will also not be in a situation to push Federal Reserve for further rate hikes. So yeah, that's what I think they are preparing or setting the tone for, and that's how I think it may play out. But we will see. But anyway, so this is coming from Bank of America. Bank of America slashes GDP forecast, sees significant risk of negative growth quarters. So BOA is also starting saying negative growth quarters. Recession is on the deck. So Bank of America stunned market when its chief economist joined JPM in slashing his GDP for 2022 for the whole 2022 year, and especially for quarter one, where his forecast has collapsed from 4% previously to just 1%. So pretty significant collapse in GDP growth there. JPM also forecast growth decelerating from 7% in fourth quarter of 2021 to 1.5% in first quarter of 2022. So as I said, yeah, the previous quarter the GDP increased by 7%, and now JPM sees it still going to 1.5%. And as the quarter comes to close, say somewhere around March, this might even go further down if that is their goal, if that is the narrative they want. What are the justifications for the revision? Of course, the first one is the sickness pandemic. That is a headwind. Second one is inventories. Inventories, because of the demand pull in the previous quarters, the inventories are already full, which means no new spending to stock up those inventories this quarter, and hence that will become a headwind for GDP growth in this quarter, potentially even in future as well. Third reason is less fiscal easing. This should never be considered an excuse for economic growth. Government spending, money printing is not a productive growth. So fiscal easing should never be considered, but this goes on to show that how much bad situation US economy and country is in, that they have to rely on the stimmy checks and money printing to justify any sort of a meaningful growth. Realistically speaking, this should always come from the private sector. So what this also goes on to show is that the private sector organic growth is basically not there anymore. Wildcard, of course, is the fourth reason for potential slowdown, namely monetary tightening. So yes, for overall year 2022, if the monetary tightening in terms of QT as well as interest rate hikes happen, then yes, it will be a significant slowdown. But I think that's where the Federal Reserve, in my opinion, is preparing to actually not do that through managing this narrative through a recession. So it looks like, not to say that United States economy is not in trouble. I think, like I said, they have always been in trouble. But going forward, as we can see, just merely saying that rate hikes are going to happen in March and in future. I mean, stock market has collapsed 10%, Nasdaq much more than that. if just saying that is can be so contractionary on the asset classes, imagine if interest rate hike happens, what it will do to the bonds, what it will do to the sovereign debt, what it will do to the um, stock market, what it will do to the housing market. So it will be like a serious serious headwind for the whole of the GDP of the economy, and don't think Federal Reserve wants that. So hence, all the shenanigans and management of perception. Anyway, that's my take on that. Please share your thoughts. Please share, subscribe, like, and I will see you in the next one. Bye.